Close your eyes and imagine this. Stock markets across the world open red. Banks quietly freeze withdrawals. Food and fuel prices jump overnight. Governments call emergency meetings as ordinary people rush to ATMs and supermarkets, desperate to protect their savings and their families. This is what a global economic collapse could look like. But the real question is, how close are we to that nightmare today? This video breaks down the hidden pressure points under the global economy in 2025. Record debt, slowing growth, new trade wars, real-world conflicts, and a fragile financial system, and asks the uncomfortable question, are we just in a slowdown or standing inches away from a systemic breakdown? Stay till the end, because the last section will cover the one scenario that almost nobody's talking about, but which could be the final push over the edge. Weak growth, the slow motion squeeze. First, look at the big picture. The World Bank says global growth in 2025 is on track to be the weakest stretch since the 2008 crisis, outside of an official recession. Growth forecasts have been cut for almost 70% of economies around the world, from rich countries to low-income nations. The core problem is simple. The world economy is still growing, but it is not growing fast enough to comfortably carry the weight of today's debt, demographics, and political tensions. The IMF has raised the probability of a U.S. recession to around 40%, driven largely by higher tariffs and policy uncertainty. When the world's largest economy slows, the shockwaves hit every continent through trade, investment, and financial markets. So we are not in free fall, but we are in a kind of slow motion squeeze. Stagnant growth, sticky inflation, and rising pressure on governments, companies, and households. The $338 trillion time bomb. Debt. Now add the second piece of this puzzle. Debt. Global debt has exploded to a record level of about $338 trillion, according to the Institute of International Finance. That is more than 3 times the size of global GDP. In the first half of 2025 alone, debt jumped by over $21 trillion, an increase similar to the spike seen at the height of the COVID crisis. Where is this debt sitting? Advanced economies like the United States, Germany, France, Japan, and the UK have all seen sharp increases. Emerging markets collectively hold more than $100 trillion of debt, with a record $32 trillion in bonds and loans coming due by the end of 2025. Think of debt as dry fuel lying around the global financial system. As long as interest rates are manageable and growth continues, that fuel just sits there. But if rates rise again, growth drops, or investor confidence cracks, the same debt can turn a small spark into a firestorm of defaults, bank failures, and market crashes. Trade wars and fragmentation, breaking the global engine. For decades, globalization was the engine that kept the world economy moving, goods moving freely, supply chains stretching across continents, capital flowing wherever returns looked best. Today, that engine is misfiring. The IMF and World Bank both highlight escalating tariffs and trade tensions as one of the major threats in 2025. The IMF notes that higher tariffs are already raising U.S. inflation and could undermine financial stability worldwide. S&P Global warns that recent tariff hikes are the largest in modern U.S. history, increasing the risk of a recession. Beyond tariffs, trade is fragmenting along geopolitical lines. A COFACE analysis shows that trade between rival geopolitical blocs, such as the U.S.-led Atlantic economies on one side and China-Russia-oriented blocs on the other, is shrinking faster than trade within those blocs. This is evidence that the world is slowly splitting into competing economic spheres. In practical terms, this means more supply chain disruptions, higher prices, less efficiency, and more vulnerability. When an economy already burdened with record debt also faces slower trade and repeated supply shocks, it becomes much more fragile. Geopolitical shockwaves. War, energy, and food. Next, factor in geopolitics. Major conflicts, from Russia's war in Ukraine to fighting in the Middle East, are not just humanitarian disasters, they also hit energy and food markets directly. S&P Global notes that wars like these have already driven up prices for key commodities, fueling higher inflation and raising living costs for millions of people. The impact is uneven. Energy importers in Europe and parts of Asia see higher fuel bills. Food importing countries in Africa, the Middle East, and South Asia get hit by higher grain prices. For countries already struggling with debt and weak currencies, these shocks can push them from stress into outright crisis. Geopolitical risk also scares investors. Capital flees unstable regions, currencies fall, debt becomes harder to roll over, and the risk of sudden financial stops rises. The more frequent and intense these crises become, the more likely it is that some part of the global system snaps. Financial system fragility, bond vigilantes, and recession risk. So what happens when you mix weak growth, record debt, and geopolitical risk? You get a very nervous financial system. The IIF warns that bond vigilantes, investors who dump the bonds of governments they see as fiscally weak, could return as debt levels keep rising in countries like Japan, Germany, and France. If investors lose confidence, they demand higher interest rates to hold government debt, which then strains budgets even more and can trigger austerity or political turmoil. At the same time, S&P Global's recession risk analysis shows that many major economies are slowing sharply, even if they are not yet in a technical recession. The United States is highlighted as particularly vulnerable to a shock from trade policy and tariffs, which could push already tight financial conditions into crisis territory. In other words, the system is stable for now, but it is not robust. It is brittle, capable of holding together under normal pressure, but at risk of sudden breakage if a big shock hits. Are we near a 2008-style collapse? This raises the question everyone wants answered. Are we close to another 2008? There are some key differences. On the positive side, regulators did strengthen banking rules after the global financial crisis, and stress tests have forced many big banks to hold more capital. Central banks also have more experience in emergency interventions, quantitative easing, liquidity lines, swap agreements, which can stop panic from turning into collapse. But there are also worrying similarities and new vulnerabilities. Debt today is much larger and spread across governments, corporations, and households worldwide. Shadow banking, private credit markets, and non-bank financial institutions play a much bigger role than they did in 2008, and they are less tightly regulated. Geopolitical fragmentation means that, in a crisis, it might be harder to coordinate a unified global response like the one seen after the Lehman Brothers collapse. Most official forecasts, World Bank, IMF, and major banks, still expect a slowdown, not an outright global depression. But those same institutions emphasize that risks are heavily tilted to the downside. That means the path we are on is narrow, and it would not take much to knock the global economy off balance. The everything bubble scenario. One of the most worrying ideas circulating among analysts is the concept of an everything bubble. Instead of one market, like U.S. housing in 2008, being overpriced, multiple asset classes around the world may be inflated at the same time. Stocks, bonds, real estate, even parts of the crypto and private equity markets. A recent analysis of global debt at $324 trillion earlier in 2025 argues that this buildup has created conditions where almost all asset values are indirectly propped up by cheap money and high leverage. If a major shock forced central banks to keep interest rates high while growth fell, say, because inflation returns due to new supply shocks, the support under many of these assets could vanish. In that scenario, you don't just get a stock market correction. You get simultaneous stress in government bonds, corporate credit, housing, and some emerging market currencies. That kind of multi-front crisis is where a slowdown risks turning into a systemic collapse. The 3 triggers to watch. So what could actually push us over the edge? 3 major triggers stand out in the current data. A sharp escalation in trade wars. The IMF warns that further tariff escalation is one of the biggest immediate risks, both for U.S. recession and global instability. If major economies lock into tit-for-tat tariffs on a wider range of goods, the effect on growth and inflation could be severe. A sudden spike in interest rates or loss of market confidence. If inflation resurges or bond investors lose faith in heavily indebted governments, yields could jump quickly. Countries and companies already near the edge would struggle to refinance their debt, leading to defaults and a tightening credit crunch. A new geopolitical shock in energy or trade routes, S&P Global and other analysts highlight that conflicts affecting major shipping lanes or energy supplies, like an escalation in the Middle East or the South China Sea, could deliver another blow to already fragile supply chains. Higher energy and food prices would again pressure households, especially in poorer countries, and force central banks into tough choices. Individually, each of these risks is dangerous. Together, they could interact and amplify one another. Why it still hasn't collapsed? Yet. Given all this, why has the global economy not already crashed? Part of the answer is resilience. Businesses have been adapting to supply chain disruptions, diversifying suppliers, and building more redundancy into their operations. Governments in many countries still have room to adjust fiscal policy, even if that space is shrinking. The other part is policy response. Central banks are trying to carefully balance inflation control with growth, and some, like the Fed and the ECB, have already slowed rate hikes or signaled more flexibility. The IMF and World Bank continue to provide emergency financing to the most vulnerable economies, preventing isolated crises from becoming full-scale contagion. So the system is strained, but it is still functioning. Think of it like an old bridge under heavy traffic. It creaks, it groans, but engineers keep reinforcing it just enough to avoid collapse. For now. How close are we really? Putting all of this together, how close are we to a global economic collapse? Growth is weak and uneven, but not yet negative on a global scale. Debt is at record levels and rising, creating serious vulnerability. Geopolitical tensions and trade wars are increasing the risk of major shocks. Financial markets are jittery, but not in full panic. Most mainstream institutions still put the probability of a major global recession, not necessarily a full collapse, as elevated but not certain. Significantly higher than a few years ago, but not inevitable. That suggests the answer is uncomfortable. We are not standing on the edge of the cliff with one foot in the air, but we are walking along a narrowing ledge with strong winds blowing. One wrong step in trade policy, one major conflict, or one miscalculation in financial markets could change the picture very quickly. What this means for ordinary people. For most people, the fear of global economic collapse is really about three things: jobs, prices, and savings. If a major downturn hits, job losses could rise as companies cut costs. Inflation could either spike if supply shocks dominate, or fall sharply if demand collapses. But in both cases, volatility would hurt households. Savings and pensions tied to markets could see sharp declines, especially if the everything bubble scenario plays out. Emerging markets are at particular risk because they face higher food and energy costs, more fragile currencies, and huge debt repayments coming due in 2025. The IIF warns that many of these countries could struggle with bond and loan maturities, raising the risk of sovereign debt crises. For viewers, understanding these dynamics is not about panic, it is about awareness and preparation. Final thought: the decisive decade. In many ways, 2025 sits at the center of a decisive decade for the global economy. The choices governments, central banks, and voters make now on debt, trade, climate, technology, and geopolitics will decide whether this is remembered as the period when the world stepped back from the brink or when slow-moving fragility finally tipped into collapse. For now, the message is clear. The global economy is not collapsing today, but the margin of safety is shrinking. And the longer the world lives with record debt, rising tensions, and weak growth, the smaller that margin becomes. If you want to stay informed about global economic risks and understand what could happen next, make sure to subscribe and turn on notifications. Comment below. Do you think the world is really on the edge, or are we just in a slowdown?